Hi, everyone. Thanks so much for joining us. Hope everybody's keeping warm. We're due for some snowy weather later this afternoon in Chicago. But we want to hear where you're tuning in. So feel free to use the question section to let us know where you're from and where you're listening from. And we love to hear. And thank you so much for joining us today. We really appreciate it. We're going to let everybody settle in for a few minutes, and then we'll begin the broadcast.
I guess it's raining in Dallas, Texas today, from what I could see.
Oh, no. I guess better than snow and ice, though.
True. Yeah, please acquaint yourself with the question process as well. We'll be using it later on to get some feedback from people and also to participate in some challenges that we have planned for you and some rewards as well.
All right.
Pittsburgh.
Well, if everybody's settled, I think we'll begin. Hello, and welcome to this afternoon's webinar, Improving Investment Performance with AAII's Essential Investing course led by Raymond A. Rondeau. And thank you so much for joining us. We're happy to have you all here. My name is Jenna Brashear, and I'll be your host for today. And a few things to go over before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And today's presentation will include several interactive quizzes. So to join in, simply type your answers in the question section of your GoToWebinar control panel when you're prompted. And if you have any questions for our speaker during the presentation, please submit them using that same question section of your GoToWebinar control panel. And then once our presentation concludes, John and I will select a few questions for Ray to answer. And if your question isn't selected during the broadcast, feel free to email us at members@aaii.com. And of course, a handout of the presentation is available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And these same presentation slides are in PDF form, and they will be emailed to all attendees later this week. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available on our YouTube channel. We'll include any links to this presentation's handouts and any other resources that we discussed today. And the PDF and the recording will also be accessible at aaii.com/webinars. And for new viewers, we always like to give a little bit of a background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And in this presentation, Ray will cover a few specific things, such as the qualities that contribute to long-term investment success, key factors to consider when choosing stocks, and evidence-based strategies to boost your performance, simple, effective techniques to manage risk across all investments, ensuring your portfolio is protected from market volatility. And if you stay tuned, we have a special holiday offer for today's attendees. And so we'll share those details shortly. And we'll be sharing our exclusive discount and BOGO deal later on during the event. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jenna, and welcome to our special presentation today. I've got the easy job of doing introduction to a man that really needs no introduction. But Raymond A. Rondeau is really a star presenter here at the association. If you've attended any local chapter events, you've probably seen him present, and he always draws well, and people always leave with a lot of information and entertained as well. And that's a difficult combination to pull off. But with that, I'm going to keep this introduction short. I know Raymond's got a wonderful array of information to present to you guys today. He's going to walk you through our Essential Investing video course and also quiz you along the way just to make sure you're paying attention. So with that, Raymond, please take it over.
Okay, John, well, thank you. We'll see if we can live up to that. Welcome to today's presentation titled How to Improve Investment Performance. As referenced in the promotion for this event, we're going to take kind of, so you think you know investing, well, prove it to us. It's kind of a fun approach with this. We want to keep it interesting. There's going to be a little bit of investing humor, We'll have some content-related investing quotes, a few interactive segments where you can win a free investment education class from our entire video education library. And that's any class that you want. We'll show you how we're going to do that coming up. To win, simply be the first person to type the correct answer into the question area when we come to the quiz. I'll ask you the question and you can type in the answer. You only can win once and you only get one guess per question. Jenna is going to be our judge, jury, and executioner. Sorry, John. And she will announce the winners at the end, and we'll get your information. We'll email you a link so you can choose any class that you want. Some of these classes go for up to $100, so it's quite a benefit. I've been doing investment education presentations for about 24 years now, and I always start with a quote and I always end with a quote. And this one's a common quote, but Benjamin Franklin once stated, "An investment in knowledge pays the best interest," which plays the double on the double entendre, best interest. For our purpose, it's going to be investing interest. The primary theme of this presentation is the importance of investment education and how it can make such a dramatic difference in the quality of your life and the lives of your loved ones. Because of this, we have an offer to give a loved one the EI course for free. A great holiday gift, that's what we think. All of this centers around AAI's newest educational offering, the AAII Essential Investing course. And although we're going to tell you a little bit about the course in these next few slides, after that, the remaining portion of this entire presentation is on the actual investment content and things that you can use to be a better investor. Let's tell you a little bit about the course in attaining AAI certification. The course currently has 17 classes and over 12 hours of material. The classes in the course are not simple recordings or a single instructor standing in front of a camera or the repackaging of a webinar or some live event like so many, quote, high educational product offerings out there. These classes are professionally produced, full-featured, interactive, multi-camera, studio-grade audio engineered recordings with a focus on essential investing principles and strategies. The course is housed in a professional learning management system, the gold standard for online learning. The course contains dozens of instruction and navigational documents and videos if you have any questions. The course includes an exam, and if passed, EI course certified participants will receive a certificate of completion and an extensive list of AAII EI course certification benefits. The primary educational content is the videos. They're full-featured scorum formatted with a jump to table of content and keyword searchable. You can type there and it'll bring you anywhere into the video. They have ongoing self-assessed quizzes, interactive hyperlinks to jump you to external content, and the ADA closed caption. This video right here shows you kind of what's in each individual class. Right here, we start with the snapshot tab, and this gives you some preliminary information about the class, about the credits, the duration, the content. From there, we have an instructors tab. Here, we give you information so you can contact the instructor. We also give you more information about some of his work. Before you take the class, we give you some keywords and definition documents to familiarize yourself with materials. We give you all the slides, and we also give you some readings that each instructor recommends you read before taking the class. The video obviously is the primary component of the class, and you can see it here. Once you finish the video, you'll be brought to a test, and you have multiple opportunities to pass a test. When you pass that test, it will open up additional content, including bonus videos, in a course segment incentive bonus, where you get a free book or a service from that specific instructor. And you'll get a certificate for completing each class and one for the course. Once you follow this section, we give you additional learning materials so you can expand your knowledge. Some of that even includes AI tools, which we'll talk about. We have a survey, a discussion forum so you can interact with other members, and even a help section. So it's quite extensive. And again, this is on each class level, not the course level. All these features and benefits we give you for a full year. We give you a full year to complete the course, and it even includes a 60-day money-back guarantee. It's really an incredible course, and there's nothing on the market like it. And I know this because we spent 5 years producing this. And I'm not kidding you, it took 5 years. The EI course is not static. We'll be releasing more already recorded classes in the near future from people like Marvin Appel from MACD or Systems and Forecasts, Fidelity's Denise Chisholm, who's one of my favorite analysts, Louis Navalier on how to pick winning stocks, and Marty Fritzen on fixed income investing. And if you don't know who Marty is, he was the youngest person ever elected to the Fixed Income Hall of Fame. You kind of get the idea. It's rare to be able to learn and be tested and to get a completion certificate from AAII and instructors of this caliber. One other area that we're not going to spend a lot of time on today, but for some people, this will be the primary driver to get EI course certified. Included with the course, no extra fees, are AAII's active investing tools, which you can see on the screen here. These should be released sometimes next year, and again, they're included for free. These are absolutely cutting-edge tools for executing, monitoring, scanning, and timing investments. Some of these even talk to you by name. They give you reports. They give you assessments in easy, clear language that you can understand. We're really excited about releasing this, and it's a nice addition to the course. If you're interested, you can go to www.aai.com/VES-education/holiday for more information, and I'm hoping Jenna can post the link for you. And at the very end, I'm going to tell you how you can give a loved one the EI course for free, and how you can get the first class in the course, Building Wealth Through Investing. We'll even give that to you free so you can try it. Which is kind of a perfect segue to now the educational content. I told you it wouldn't be too bad. The first thing we're going to look at today is material based on the Building Wealth Through Investing class. And we're going to see if we can make a positive difference in everyone's life, say over the next 35 to 40 minutes. And we're going to try to have some fun while we do it. How to improve investment return. Of course, this somewhat assumes or implies that you're already investing, which is not always the case. And that's where we're going to start. Why should I invest? Can I be successful? What does it take to be a successful investor? And how do I put myself in the best position possible to maximize or improve performance? And for that, we're going to need techniques and strategies. We start with a story, a true story, but the underlying concepts of this story are not necessarily novel, but this really did happen. For years, I had been part of and oversaw an advanced group of investors and traders that met regularly at MIT and Cambridge and Boston. And as you can imagine, it was a competitive environment, and we like to encourage and challenge each other. So about 20 years ago, it was back that far, we had a graduating student propose a challenge to the group. We'll refer to him as Shane. We kind of changed his name to protect the innocent. Okay, we didn't. His name was Shane. But Shane was going to become a dad, and he wanted the following for his son. He wanted to legacy $1 million to his son at his son's retirement. That's important. He wanted to do this through investing. He had no money to invest, made it a little challenging. He didn't want to do any additional work or effort. Basically, he wanted to live the same exact lifestyle with no sacrifices, as if this goal never existed. Now, obviously, Shane was being slightly facetious here with his desire to bequeath $1 million with nothing to invest and with no effort, but it made an interesting challenge and subsequently a valuable study that led to a number of important investment-related ideas and strategies, and we're going to refer to these as revelations. After debate and deliberations, we agreed on a theoretical compromise, and this is what we agreed on. We needed some money to start the investment process, so we decided on $2.76 a day. And basically this came from the price of 2 bottles of water, which is another story on its own. Now, 2 things here. We're looking at about $20 a week, less than $20 a week. 2 things. This is not a new concept, which we know. And I know that we said Shane didn't want to sacrifice anything, but we're going to remedy that at the end. But this is what we originally started with. He's not going to sacrifice even a bottle of water. Okay, so here we go. We propose that Shane will invest $83 a month, only for the first 18 years of his son's life, only for 18 years. So the question becomes, how much money would Shane have to bequeath his son? Now, if you start typing, don't start typing quite yet, right? Because we're missing a key ingredient here. And what is the ingredient that we're missing? We don't know the anticipated percentage return on the investments. So we go to the cost. In this table, we have some statistics on historical percentage returns of US stocks in various asset classes from everyone's favorite, Paul Merriman, who does, again, an excellent presentation in one of the VES classes. Now, we didn't take Paul's findings of 14.4% on small cap value. We just went with a nice round, middle of the road historic average number of 11% for equities. With a long-term time horizon of 7 years, 100% equity exposure seems reasonable throughout most of this duration. So now here is the question. What do you think? And we're going to give you a minute to type in your answer, and you only get one guess, okay? How much money would Shane accumulate after investing $1,000 per year with a return of 11% after 18 years? How much money do you think Shane would accumulate? $1,000 per year after 18 years. Well, we know he put $18,000 in, but at an 11% return. Give you few more seconds here. Should have some music, right? The Jeopardy music. Okay. Hopefully some of you put some answers in. Well, after the first 18 years, the final balance, even with $18,000 worth of contributions, was only $53,000, $53,137. And whoever comes closest will win. And that's not very good, is it? But before you turn off your computer, according to the plan, Shane doesn't add another penny and simply lets it ride. So now we're going to give you another shot here. How much would Shane have to bequeath his son, presumably in a trust, when his son turns 70? And again, in this one, whoever comes closest to the exact dollar amount without going over. Okay, we don't want the prices right here where people go $1 more, $1 more. It comes closest without going over. $7 years is a long time, but he's only put up $1,000 for 18 years. All right, what was the goal? The goal was $1 million. Are you ready? It comes out to over 12 million in today's value dollars to Shane's son at his son's retirement, all for sacrificing a couple of bottles of water each day and only for 18 years of Shane's life. This is money that can make a real difference. Now, of course, this is purely hypothetical, right? We're assuming historical returns, which is all we have to base an assumption on, but we're leaving out some serious factors here. Commissions and fees, in truth, they're becoming a thing of the past. Slippage, this is an underrated loss that I'm going to show you ways to deal with coming up in the next section. Taxes are not minimum, but there's a strategies to reduce this effect. We have a class on that with Charles Ropeblot. I don't touch taxes. And inflation will significantly reduce this true value, but $12 million is still $12 million. So after several months of meeting on this up at MIT, there were several repeated lessons or revelations that kept coming up that became apparent for building long-term wealth through investing. And these were from the group's experiences in their rather extensive research on this topic and strategy design. with an estimated 700 plus years of combined knowledge in that room from a high-profile group of full-time investors, professional traders, and educators on trading and investing. And in the remaining part of this section, we're going to look at some of these 16 revelations for creating wealth through investing, and we'll intertwine some strategies as we go through these. Revelation number 1, and you'll know some of these, have a plan, right? With a thorough, reasonable, and attainable plan, it was believed that investors would be more likely to achieve their goals and get to where they wanted to go. And they need to know where they want to get to. It seemed that successful investors had a plan, and with a plan, it reduced the tendency to act emotionally and subsequently chase returns buying high and liquidating investments during major sell-offs, selling low. It was believed that investors who had a plan seemed to stay focused and in wise mind, where they made better overall decisions. Revelation number 2. An investor had to accept that variables and uncertainties in the markets exist and that no plan is perfect. I agree. We do not know what the future historical stock market returns are going to be, but to design a strategy, we have to make assumptions and projections based on the best returns, best information that we have. We need to control what we can and accept what we can't. And I think most people would agree that having an investment plan that's not perfect or foolproof, seldom things are in life, is better than having no plan at all. Revelation 3, there is or was no single best plan or strategy for every person in every situation. That an individual's ultimate approach in their selected best investment strategy had to be based on and in line with their own personal situation. Some of these areas are listed here. And an investor also has to realize that even though those will change throughout one's lifetime, so they need knowledge and the ability to adapt. Put another way, the right way to invest and the right strategy is the one that's right for you. It's not necessarily universal. Another revelation that the group believed, don't be afraid to think outside the box with alternate solutions. In Shane's case, everyone came up with different ways to invest, and everyone came up with different ways to accumulate the funds to invest. Part of the reason this challenge started was a debate over bottled water. People at MIT will debate anything, trust me, I know. With that group, most people's big lifestyle change was purchasing a $150 distiller or home water filtration system, as opposed to spending $1.50 for filtered water that really comes from a big city public municipal water supply, at least for the two biggest suppliers in the US. They reasoned that it was cheaper, they didn't have to lug it, and it was better for the environment and, of course, their finances. But Shane thought out of the box, or the bottle in this case. His solution choice was, instead of paying cash or using a debit card for regular purchase, he started using a credit card with a 2% reward on all of his purchases. And the card he chose automatically transferred the rewards directly into his brokerage account. And these cards still exist today. And at the end of this section, I will show you how Shane expands this to attain 7% risk-free with no money. But for now, at 2% with this approach, he has no changes in his lifestyle, and it does not require any additional effort, meeting our criteria. At the time of this study, US budget statistics showed expenses for the average family were around $53,000. You can see it right here. This was more than enough to get him to his target of $2.76 a day. But the key word here is directly. This strategy directly transferred the money into his accounts. Revelation 5, voted on as the second most important aspect of being a successful investor, discipline. For this strategy to be effective, Shane had to actually invest the reward money and pay the credit card each month in full. The best investment plans and strategies in the world won't work if an investor doesn't follow them. In fact, it's routinely found in hindsight that the reason that most investors fail is not because of failure of the strategy, but because the person failed to follow the strategy. In fact, the 2022 study by Dalbas showed that over the previous 30-year period, the S&P 500 average return was 9.65%, while the average equity mutual fund investors' return was only 6.81%. Now, there are probably many reasons for this, but certainly one of them could be that emotions cause many investors, presumably without a plan, to chase price in uptrends and then panic and sell in downtrends. Revelation 6, good investors don't fear technology. And for those that don't want to use it directly, they're open to using the information derived from it to their advantage. On this video, you can see the program we use for testing factors and developing technical-based investment strategies. And we will look at one of these strategies in a few minutes. With this program, we can generate hundreds of fields of information on hundreds of stocks over decades when testing a theory. Then we can use the program to optimize the individual factors and then synergize these multiple factors to creating a trading system or investment strategy. Now, this isn't foolproof and it isn't easy, and it often takes hundreds of lines of code and weeks to develop a good system, but research like this is invaluable. Some good news, Revelation 7. The group as a whole believed that investing plans and strategies did not have to be complex to be effective. This was somewhat surprising to me. Here I can state, though, from a chart reading perspective, there's definitely a law of diminishing returns. The truth is that the average investor can gain a large percentage of the benefit of chart reading while only knowing a small percentage of the technical theory. 3 or 4 key patterns, maybe 1 or 2 indicators is the most investors will need. And these are all covered in the course. We're not going to talk about charting here today. Here's a couple of simple examples of strategies for mutual fund investors, just to get us warmed up and get us going. In this table, we can see results from a study published in Stocks and Commodities magazine in 2023 on the average returns of each day of the week of the S&P 500 from 1965 through June of 2023. And as replicated by many, they showed that Mondays were the worst performing day of the week, with an average accumulated average yearly return of a shocking minus 1.75%. And it only gets worse for small caps, with the Russell 2000 coming in at minus 2.19% as measured from the year 2000. Look at that differential. Okay, it's interesting. Now, how might a mutual fund or any fund investor use this information? Well, they could time their periodic weekly purchases on a Monday, getting lower relative entry prices. Another reasonable approach might be after a major sell-off in the previous week to consider refraining from reviewing your accounts on the weekend, getting sticker shock, panicking, and then entering fund redemption orders. These orders would be filled at Monday's close, which are historically lower, especially in this situation. There's reasons that Mondays are lower. At least according to statistics, you might be better off waiting for turnaround Tuesday and getting probable higher prices if you still want out. Simple approaches. Here's another one. It's been believed and it's been measured that the last days of the month, and the last day of the month, and the first day of the month are the best performing days. The Journal of Wealth Management published a study reinforcing this phenomenon. So for those who dollar cost average for purchases into mutual funds, a good strategy, on a monthly basis, perhaps they should consider not transacting at this time like most investors. Again, there's a reason for this. Their research suggested purchasing on the 23rd of each month and doing periodic redemptions on the 1st when prices tend to be higher. Revelation 8, intellectual-based investment research approaches and strategies seem to be more effective. back home to me, right? And this is a pillar of AAII, evidence-backed research. We just touched on this and showed you a program that I use to generate strategies. Here it was believed that for no other reason, if an investor believes in and understands a strategy, and there's evidence supporting the strategy's effectiveness in the risk-reward profile of that strategy, they're more likely to follow it. They're not as surprised when there's a drawdown. In the course, Wayne Thorpe has 3 classes on stock investing, and one of those classes focuses on important factors when using a fundamental stock investing approach. Please remember, I'm a technician. I use technicals. In fact, one fundamental stock factor or measurement was so relevant that the co-authors of the paper actually won a Nobel Prize for their work, Farmer and French. As they showed in a study from 1963 to 1990, that stocks with the lowest price to book value ratio outperformed those with the highest ratio, you can see it right here, by over 13% per year, based on one factor. It's this type of research and these types of factors that many of AI's fundamental stock screens are based on. Revelation 9, when considering any investment strategy, it's good for an investor to be skeptical and to be sure what they are looking at is accurate and realistic. And in today's political environment, I don't think I have to convince anybody of this, right? There are many potential problems with backtesting, interpreting investment news, statistics, and strategies. Numbers can easily be manipulated. But I have a few key suggestions in this area. Ask yourself if the strategy's results were generated across both good and bad market environments. Look for detailed backtested results over long time periods on hundreds of stocks, not 1 or 2 stocks. And see if the results have been accurately reproduced by an independent third party and if the results are certified. We're not going to look at my AI technical-based stock strategies today, but this one on the screen is called Kinetic Conviction, which is covered thoroughly in the course in an optional segment. And you can see the produced backtested performance results here with a near 82% hit rate with an incredible profit factor of 3.73 to 1. Here's the computer-generated back-tested realized equity curve for the Kinetic Conviction profit factor system, and anybody can reproduce this themselves. This was on every single stock in the S&P 500 over a 10-year period, and it didn't even flinch during COVID. It works over good and bad market periods, and it was a long-only strategy. If you want the performance report showing the system parameters, hit ratios, projected returns, some of the popular ratios, transaction, entry and exit efficiencies, drawdowns, and even every single trade, some of these are over 100 pages, we'll give them to you. And if you want the full instruction manuals and information where you can get these types of systems, you can just reach out to me and I will send them to you. We're here to help. And yes, I do have to say we had all 3 of our technical-based system performance reports and results certified by an independent third-party company called QuantKey. Revelation 10, even with the best of intentions and exemplary research and testing, investing strategies are still about probabilities. They are not guarantees. This is important. Successful investors accept that strategies, approaches, and methods are what they are. They are not infallible and they're not going to work all the time. No matter how many things line up, there's never a guarantee the approach can still fail. Successful investors and good investors have to accept this reality. But this is why they use risk control techniques. And I'm sure you know we were going to be getting to that. Revelation 11, sound investing strategies focus on risk first. Buffett's 2 rules of investing. Rule number 1, never lose money. And rule number 2, you don't even need to type it in because we all know it. He's an incredible investor. Never forget rule 1. Now with that, I'm going to throw you a curveball here. And this is where things start to get interesting. Although there's a definite correlation between return and perceived risk, this is a fundamental principle of finance in the investing world, there has to be a point of balance. And I'm going to try to get you to consider higher returning investment types if your situation supports it. And this may be a little out of line with some of AAII's normal teachings. Revelation number 12, although it may not be the eighth wonder of the world, and Einstein did not at least originally state it, compound interest is an extremely beneficial force for investors, with even a greater effect than we anticipate, as we saw with the example with Shane going to $12 million. Two well-known rules on compound interest that are worth at least mentioning here. Number one, the more frequent the compounding, the greater the effect. Banks use this against us all the time. And number two, the longer the time period, the larger the compounding effect, as we've seen again with the example of Shane. Revelation 13, we're building off of that. Start early in investing something is better than investing nothing. But to start early, look at this chart here. Look at the halfway point after the first at year 26 with our example with Shane. At that point, his profit was only $748,000. It was in the next 26 years that Shane accumulated 11.28 million more profit. Unfortunately, many younger investors don't want to hear or accept this revelation, but they need to, and that's why we're offering you a free EI course for your loved ones who very well might likely be younger. It's critical to get people to start early and contribute what they can, no matter how small the amount. Revelation 14 is something that many older investors don't want to hear. Fortunately, in AAII, we don't have many senior members, but I'm going to cover this anyway just to be polite. Revelation 14, a few percentage points more of return makes a big difference in the outcome. In this table, we see that a 5% return with the parameters of our example with Shane gave a final balance of about $363,000. But at an 11% return, Shane got to his $12 million. A percentage return is a critical factor here. Expanding on this, and this is a critical slide, percentage return differences are not linear. A 3% increase right here will say from 2 to 5% only nets an additional $303,000. And this questions the strategy of reaching for yield at so-called lower safe target amounts, as this is where many older investors want to be, and it creates a supply-demand imbalance. I'm a member of the National Association of Active Investment Managers, and I often hear, Ray, make as much as you can, but don't lose any money. Well, that's a crowded trade right there. A lot of people want to be there. But as we can see now, the same 3% difference in return from 11%, we'll say now to 14%, nets an additional $54 million. This reinforces the case for a higher small cap equity portfolio weighting if you have a longer time horizon and if your personal situation supports it. And this is a foundational AAI position. If you recall earlier from the research by Paul Merriman, he showed that small cap value stocks returned 14.4% over his 90-year plus period. So it's important to understand that the percentage return makes a big difference, and that changes are not linear. The higher you get up the scale, the more influence it's going to have. And this leads us to a final revelation in this section. And we're going to give you a free class on this one. So get ready to type and type quickly. We want to know who stated this, and I'm going to read it to you. If I was running $1 million or $10 million for that matter, I'd be fully invested. Anyone who says that size does not hurt investment performance is selling. The highest rates of returns I ever achieved were in the 1950s. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on 1 million. No, I know I could. I guarantee that. The person who says this, or who stated this, may surprise you. I'm assuming that we have the correct answer by now. Unbelievably, it was stated by Warren Buffett in a Business Week article titled "The Homespun Wisdom from the Oracle of Omaha," and it was in July 5th, 1999. And I, for one, am not going to argue with him. In this course, we have numerous quotes from other investing legends like Fidelity's Peter Lynch, all implying and or supporting Revelation 15. Small individual investors have numerous and significant advantages over larger ones, and successful investors use this to their advantage. This is a core belief of AAII, and it's covered extensively in the course. Where do small investors have an advantage? I'm going to show you some areas, and how do they exploit them? This brings us back to Shane. Shane also did this by leveraging his smaller size to his advantage. After making large purchases with his 2% deposited into his brokerage firm, he took advantage of one of the plethora of 0% credit card offers that were available at that time. He opened the new 0% card, transferred the balance from the 2% card, and at that time there was so much competition to attract debt for those who didn't pay off their balances. Discipline again. There were no transaction fees, and the offers were for extended periods of time for 12 to 18 months periods. So then Shane takes that 2%, and he takes that money, floats it over, and he uses that money to buy 6-month and 1-year CDs that were paying over 5% at the time. When the CD expires, he took the principal, paid off the 2% card, and enjoyed a 7% risk-free return on his purchase. It was a simple approach where he took advantage of a system that was looking to take advantage of him, and he was seemingly creating money out of thin air. And then he did other things to get his returns into double digits. Again, here in this slide shows the importance of what a few more percentage points of returns will do. Now, these techniques, as well as many other ways to generate money to invest, if somebody else is already using credit card, are covered a lot more detail in the course. Okay, we just wanted to touch on this. We had about 25 minutes in this segment, and the course goes, this particular class and segment goes for about 2 hours of content. But it's an interesting study with a lot of useful information. Bringing us to section 2, a wealth building evolution. Before we get to our final revelation for our story with Shane, and you probably already know what that is, we're going to look at 3 general areas or lessons that repeatedly surface from the various instructors in the EI course for improving investment performance. And unfortunately, some of these are not as popular as some of the other revelations. We're going to start with a quiz. Okay, get ready to type. What asset class has been ranked #1 in the Callan tables 8 times in the last 11-year period from 2013 through 2023? And it's probably going to be #1 again this year. Which asset class was ranked #1 8 out of 11 years? Okay, I can't see your answers, but I know AI members are smart, so I'm assuming you're going to get this, right? It's Bitcoin. You can see it right here in black. You can also see there was the worst performing in these 3 years, right? It's reported that more than 20% of Americans have some form of crypto. That means there are more crypto owners than dogs. Don't tell my dog Evie that. Okay, it's an estimated that over 50% of investors have some form of crypto. But here's the kicker. What's disappointing is that a lower percentage of older, so-called more experienced and astute investors are participating in this as compared to younger investors. And AI has a new area coming out that may address this. But for now, why or how could this be? Our first theme on improving investment returns that was covered by many instructors in the course was that good investors are open to new opportunities, concepts, and ideas, and most importantly, they evolve with the markets. We know that our markets are constantly changing for some of the reasons displayed in this slide. And this creates a lot of opportunities for smaller individual investors to exploit. But on the flip side, and there's always a flip side, some investors who are reluctant to evolve and who are using the same techniques, investment vehicles, and tools that were developed 40 and 50 years ago are very likely at a disadvantage. And in this section, we're going to show you a few of these, and so you can kind of gauge or test yourself where you are on this scale. In this video, you're going to see me placing and moving orders to purchase 50 shares of gold, the ETF Gold, GLD. And what do you notice? Every time I'm moving my order, look at the bids. The inside bid is moving, it's adjusting. Do you see how that's happening? Now, this was recorded in a quiet time, so you could see what was going on here. But look at this, goes on for literally 7 minutes. I'm not going to play this for 7 minutes. So it's an interesting phenomenon here. So why am I showing you this? To illustrate how our markets have changed and how front running and order manipulations are a real problem for investors today. And if you question this, ask yourself how brokerage firms are making money with no commission trades. They're still making money, but just in a different manner through order flow sales looking to front run and capture the spread. And what is the difference between the bid and ask spread? It's right here. It's the spread, excuse me, is the difference between the bid and ask. And in this case, it's 9 cents. Now you may say, Ray, it's only 9 cents. But let's take a look, because you know where I'm going to go with this. Let's say we go with 5 cents. How much do you think saving only 5 cents on a buy execution on 200 shares of stock would improve your financial situation? For this example, we'll say 35 years out at an 11% annual return. And we're not going to quiz you on this one. 35 years, somewhere in the middle of their investing years, right? 11% annual return we've been using all along. The answer is you'd have an additional $375 for every $10 gain on an entry or an exit transaction with these parameters due to compounding. $750 on each trade round trip, 35 years out, you're sacrificing at an 11% projected future return. That's literally hundreds of thousands of dollars over the average stock investor's lifetime, and where brokerage firms are making their money. I want you to look at this another way from a dividend investor's perspective. In AAII course, we have an entire class on dividend investing. And we show that 40% of the total returns from stocks in the S&P 500 come from dividends. Good. And we also show that over a 45 plus year time period, dividend growers right here outperform non-dividend paying stocks by 4.3% a year. Good again. At times, not at all times, investing in dividend paying stocks is a sound approach, but more so for those who are aware of the changing market environment. For example, let's say a stock is trading at $10 with a 20-cent spread, and that is a little wide. Even based on a potential mid-fair value of $10, which is highly unlikely, you're not going to get that if you use a market order, and you shouldn't. You're going to be giving up 2% on the buy and sell by not using proper order execution techniques. In this example, an investor would be giving up the entire dividend yield just to execute. The point here is that you should never use a market order, or almost never, and you should learn when, the day and the time of the day to and not place orders, what types of orders to use, and what prices and which qualifiers to use. It's an important aspect of investing that many investors don't want to focus on. And all these are covered in the orders and execution class. But I'm going to give you one type of order that I want to mention here just to kind of whet your appetite, and that's bracket orders. Essentially, all brokerage firms now have them, but they don't push them, again, for obvious reasons. It's their profits, because they use limit orders. And because of this, many investors don't even know about bracket orders. But really quickly, what a bracket order does is you can put your profit target and your stop loss in at the same time on a stock or ETF position. and it can be filled at any point in the future. An example would be this: I purchased a stock for $100 and I want to take a portion of profits at 120, or I want to get out if prices fall below, we'll say $92. With the bracket order, you don't have to decide if you want to place protection to reduce your risk or a profit order to lock in some gains if price jumps up really quickly. You can have both orders sitting in the market simultaneously, and when one order is filled, the other one goes away. There's many types of orders that can assist today's investors. Now, I know what some of you may be thinking. Ray, I'm pretty much a fund investor, so most of the things you're covering here today really don't match my approach. Leading to our second general theme in the course on improving investment returns, complacency, which is tied to market evolution. Successful investors are never complacent, and they're always looking for ways to reduce risk or improve in performance. Or better phrased with the proverb, success breeds complacency, but then complacency can breed failure. And in these next few slides, we're going to look at some ways fund investors can be more proactive to improve their returns. This slide is from Morningstar's Ben Johnson's class on ETFs. Here you can see in his list the advantages and disadvantages of mutual funds to ETFs. And what do you see here? Well, at least according to Ben, by essentially all metrics, ETFs have advantages over mutual funds when appropriate. And I would agree with this. And this is especially true now that transaction costs are a thing of the past with the ETFs, which is a good evolution. And if you know how to save the spread, it even makes it more valuable, which we just touched on. And this is a key slide from the course. And again, please understand the class that we're covering right now is a 2-hour class. We're not showing you the primary material. We're just covering a few general areas here, but this is the key slide. In this table, you can see the differences in returns with investing in mutual funds, ETFs, and a no-fee investment. And their numbers are right there. At their respective average fee levels with the same parameters with our example with Shane. We're talking about over a $1.5 million return difference between an investor who uses a mutual fund and an ETF at these average equity fee levels. And the fee amounts that we are using are for US equity-based investments as reported by the ICI, the Investment Company Institute in 2022. That's a lot of money for such a simple adjustment by anyone's standards, I guess unless you maybe you're Elon Musk. But why stop there? We already touched on the day, month timing, and dollar cost averaging. But what about tax strategies with funds like tax loss harvesting, strategic holding periods, and matching appropriate fund investments to tax deferred accounts? How about ways to deal with executions around distribution dates? We're in that season now. And then there are fund selection. What metrics and areas should you look at when selecting a fund besides fees? That's only one measurement. All of these are covered in the course and they can make a real difference. Index versus active managed funds. I get that question all the time. According to research produced by Morningstar, and they're experts in this area, the answer is not either or. The answer is both, as they show that there are 3 asset classes where active managers routinely and consistently outperform index versions. These areas are logical if you think about it. Everyone should know them. And they, like all the strategies covered in course, can make a real big difference in your return. We just showed how the 0.28% difference made a $1.5 million difference. How about sector and seasonal cycles that can be used to a fund investor's advantage? And this is going to be our last example today. In this slide, you can see results from the CFRA on a well-known seasonal cycle sell in May and go away. The data clearly supports the relationship that equities have historically performed better from November through April. And there's several important points here in this chart. First, the relationship is reflected in both average return, right here, and the number of positive period returns. Look at that. The relationship has existed for a fairly long time, as far back, this is measured as far back as 1945. And I think most profound, that the relationship seems consistent regardless of market cap size and geographical location. It even works for foreign markets, and more so. Knowledgeable fund investors can use this to their advantage. The most common approach is detailed in these tables. On the left, we can see the overall return for a buy and hold investor from 1945 with $1,000 through 2017. On the right, we can see the overall return if an investor switched to T-bills from May through October. This strategy not only outperformed, but it reduced an investor's equity risk in half, as now you're only in the markets half the time. And the T-bills also would have a tax advantage. Now, this strategy has merit, and this strategy can be greatly enhanced with more sophisticated approaches using a spread arbitrage position technique exploiting contango and backwardation relationships. Now, this strategy would take too much time to cover, and it's really more for advanced investors, but it is covered as an optional class in the EI course. Again, it's not part of the certification process, but I want to make clear that this course has a lot of advanced strategies. Our third lesson from the course for improving investment performance, and it's controversial with some AAI members, adjusting asset allocations to the current market environment, call it market timing if you will, can be advantageous for the disciplined, educated investor. And this could be something as simple as shifting allocations to or from CDs. I think most investors would agree or question if it really made sense to hold one-year CDs when rates were literally below 0.5% from 2011 through 2017. That is an element of investment timing. And investment timing or market timing doesn't always have to be about beating a market. Sometimes it's about controlling risk. Here we have one of the most popular technical timing strategies, where we see golden crosses where the 50-period moving average crosses up over 200-period moving average, and death crosses when the opposite happens. This strategy's main goal is to try and avoid large drops while maintaining a position to be in the markets the majority of time, because the markets have an upward overall bias. This is a good strategy for older investors who still want equity exposure, but they just can't take the 40% drop at this stage in their life. So is this strategy effective? Well, yes and no. It's not necessarily going to outperform the market, but it does protect. For example, in the dot-com crash from 2000 to 2023, and you can see the exits right here and the entrances back in right here, you would have gotten out about 9.1% from the top. It doesn't hit the exact top. You can see the red arrow. And you would have gotten back in right here, but you would have gained plus 31% return from a pure buy and hold approach. We'll look at another area during the Great Recession, 2008 to 2009. Well, you would have gotten out right here, only 6.4% from the exact top, but you wouldn't have got back in at the very bottom, but you still would have gained 30% on the market with a lot less stress and a lot less pain. It's a strategy to help protect assets during a big drop. Unfortunately, during COVID, the crash, you didn't gain much. This was not typical market behavior. The Fed fixed that drop. They didn't want to make the mistakes of 2008, but still you did gain a little bit and you sat out most of the pain, unless you got COVID, of course. Anyone can set up this strategy for free on the internet, and you only have to check it a few times a month. With this strategy over the past 15 years, it only generated 3 signals that got you out, and then that did not get you back in at a better price. Only 3 times in 15 years. AAI has a free tool coming out for this purpose, and this tool projects the future price needed. You can see it here at any moment to generate a bullish or bearish sell signal into the future. And we'll be posting these signals every week on AAI's Active Investing webpage. Just think of it like a technical AAI sentiment survey. Now, if you noticed, I said AAI's Active Investing webpage. We have some good news here, as AAI is planning on coming out very shortly with a new area called Active Investing. This area will be more for more hands-on investors. It's for investors who are interested in investing in multiple areas like stocks, bonds, ETFs, commodities, and yes, crypto. And they're open to using a variety of techniques like hedging and technical timing models, spreads, and various option strategies like covered calls and cash secured puts. So we're excited about that. Last section, and this section's only 4 minutes, just so you know, the key to improving investment performance. Here we're going to recap the main themes in the presentation. We're going to give you the final revelation. We're going to provide you with information for the free office. We will announce today's whiz quiz winners who will get any free class they want in the VS library. And then with John and Jenna's help, we can jump to a few questions. For most people, investing is a necessarily and realistic option to achieve true financial freedom. To be a successful investor, you must not only have knowledge, but current knowledge. What worked yesterday is really the most efficient approach for today. Successful investors acknowledge that our markets are constantly evolving and they evolve with them, and they look to take advantage of and exploit new opportunities by using their investment knowledge. That's why you're with AAII. Successful investors also realize that small increases in return, especially in the upper portion due to compounding, can make a dramatic difference in their overall performance over a lifetime. They know how to create a plan that's right for them. They have the discipline to follow that plan, and they focus on risk, controlling what they can and what they can't. As shown, investing knowledge is one of the fundamental or foundational elements needed to be successful, but there are two others. First, it's critical to not only attain the knowledge, but apply it and then take action. And I told you we would end with a quote, put much more eloquently from one of the smartest men to probably ever live, Leonardo da Vinci. Knowing is not enough. We must apply. Willing is not enough. We must do. Leading to our final revelation. And without this one, none of the others matter. Revelation 16, the building of wealth through investing is possible for the individual investor. Without the belief, people won't even try. Part of the purpose of this presentation. As Henry Ford once stated, those who believe they can do something and those who believe they can't are usually both right. To be a successful investor, it does not take necessarily a special skill set, sophisticated strategies, lots of money, as we've shown, or a lot of expensive equipment or complicated software. But it does take knowledge to develop sound, modern investing approaches with a plan and a set of strategies that is right for them and that works in today's market environment. And that is what the EI course focuses on. Evidence-backed strategies that can be used by all types of investors with all types of investment types and with a variety of approaches. For this, AI has put together some really nice offers. Everyone in attendance can get both, the building wealth through investing class for free, which was the primary focus of the presentation today. You can get this by going to the website. Again, I told it to you, www.aai.com/VESeducation/holiday. On the same site, we also have a link for those that want to take advantage of the EI course VIP holiday rate. And they just want to get certified right now and attain all the EI course certification benefits. And this includes access to all the current and future education classes and the entire AI video education library and the active investing tools that are going to be released in 2025. And for those people who sign up for the EI course, we're even going to give one EI course to your friends or family, which is what we discuss. This is a great holiday gift, and it's a gift that can make a real difference in someone's life, especially if you have children or grandchildren. And although I know they may prefer that trip to Aruba or that jet ski, just tell them that you give them that gift right after they attain the EI course certification for completing the course. And believe it or not, I actually had a friend of mine who did that very thing, and their daughter finished the course in 2.5 weeks. Here's the details. If you purchase the EI course by December 9th, that's important, simply email or call AAII customer service and provide them the name and email address on the gift of the gift recipient. Around December 20th, both of you will receive an email from AAII notifying them of the gift and that you sent it to them. Again, 2 things to keep in mind. The offer ends December 9th. And 2, once the gift offer email has been sent out, you're no longer eligible for the 60-day money-back guarantee. That would seem obvious, but I need to mention it. This still gives you a few weeks to work with the cost to decide. If you want to learn more about the AAII cost before deciding, you can go to this website, www.aai.com/learn. We have more than a dozen documents and videos about the course. You can see the itinerary, all the course features, the certification, and the entire process. My sincerest hope here is that you learn something in this presentation that will help you improve your investment performance and, more importantly, propel you to keep learning and expanding your investment knowledge. As there's few things in life that can bring so much potential benefit to someone and that require so little benefit, because I know it's kind of corny, but the most important investment that one can make is truly investing in themselves. My name is Raymond Rondeau. I'm an investment strategist and senior technical analyst with AAII. I will personally want to thank you for your time. And after doing 200 plus live events, it's hard for me to end the presentation without even getting a token of applause. So I'm going to need about my webinar skills here. I'm going to turn it over to Jen and John now.
A great presentation, Ray. Very, very entertaining. You kept the audience here the whole time, so it's people were getting a lot out of it. So I'm here to, I guess, try to quiz you yourself, and we could have Jenna do the announcements of the winners in a moment. But a couple of questions came up. Here we have Jim Weiss. Roughly, how long does it take to complete the course?
That's really up to how much knowledge you have going in. I'm not right, and how detailed you want to. You really want to read every article, etc. I would say on the short side, you're probably looking at a couple of weeks if you want to put a few hours a night in, and then on the long side, who knows? But I mean, if you're a complete novice and you want to read everything, you know, you could spend a couple months in that course at a few hours per night.
Makes sense. Thank you. In terms of a couple of questions were coming up as far as the class itinerary, what it covers. So we had a question, does it cover ETFs? And you kind of pointed that out as the class went on. There is a class on ETFs. When it comes to fundamental stock analysis, what kind of options do people have in terms of fundamental stock analysis in the course currently?
Oh boy, I didn't bring you over to my side, the technical side, huh? That's okay. On fundamental stock analysis, Wayne Thorpe really focuses in that area, and he has 2 classes, and they probably total about 2.5 hours of material on fundamental analysis, on factors, some of his favorites of stock strategy, fundamental stock strategy, and stock screening, and how to do that. And he also has a bunch of bonus videos. He does a nice job.
Thank you. When it comes to, and this is you mentioned you showed some back testing results. I had a member here who was wondering which system you use to do your back tests.
So that system that I show and the system that I use is it's called Portfolio Maestro with TradeStation. We've partnered with TradeStation. All the tools that I told you about, which we really didn't cover today, and all these strategies that are included with the course will be in the TradeStation platform. There's no cost for this. I'll let John, you expand on that, but it is through Portfolio Maestro in TradeStation.
Thank you. You know, there's more of a hypothetical question as far as your analysis, what you think, you know, with the impact of AI, you mentioned Bitcoin. I mean, to what extent, how helpful are the historic records as far as rate of return, given some of the changes that have occurred in the market? How helpful are they as far as giving us guidance going forward?
I mean, it's a fair question, right? And with Bitcoin, I understand there's just not enough data. It's constantly evolving and changing, and it shifts like the wind. What I would say with Bitcoin, I was talking to John about this about a week ago, was if you're going to be a Bitcoin player, using technicals is a big component of that. But how much relevancy you put on historical analysis? I certainly put a lot. It's all we have. Some would say that every time we make a decision, it's based on history and looking back in our experiences. So I put a lot on it, but some people may not.
Understood. This is more of a technical question. I'm not sure if you could answer this or not, but if someone signs up for the free course now, would it override on my purchase course? I think you could do both. Is that correct?
If somebody, could you repeat that question, John? Or you could answer it, sir?
If I sign up for the free course now, would it override on my purchase course if I have not completed it yet?
I'm not sure I understand that question, John. I
No,
apologize.
okay.
Maybe you can take it.
Yeah, I guess we'll have to get back then to the member here who asked that question later. Sorry, let me be you know that offhand, but fair enough. I'm trying to stump you here, Ray. Sorry about that.
Well, you stumped me with that. I just not quite sure. He already purchased the course. I'm not sure if he's saying he wants to take advantage of the offer and buy ones for love. I'm not
I think,
sure.
yeah, correct.
Yeah. Oh, yeah. Well, that is something that you can certainly do, and you have to talk to the big man about that. But yes.
Again, a lot of great people really love your class enough, the presentation. They loved it a lot today. Getting a lot of great presentation I've ever seen here, at least as far as the comments. But a question
Thanks,
here.
Mom. I didn't know my mom was going to touch. I'm totally kidding.
Fair enough. Well, you know, my mom was on too, so she must have been her. So
Okay.
covered calls. Is the class covered calls currently?
Okay, that's an excellent question. Right now, currently, as the course has, we do not have the classes up for options. Remember, you get the classes going forward. I can't give you the names, but if you could name 3 big option names in the industry, we have contact with all 3 of them, and they all showed interest in doing a class in the future. But right now, we do not have classes on that. That's important.
Okay, thank you. Let's see here. Not getting too many additional questions here. A lot of thanks as far as the class. I guess with that, Jenna, why don't you come on up and tell us who the winners are?
Yeah.
Hi, everyone. Thanks for being so patient. We appreciate you attending today and participating in all of our interactive quizzes. Ray was trying to stump you, and everybody tried to get their answers as quick as possible. We saw them come in. But our winners are for today are Alan H., Bozzy K., David J., Steve G., and Charlie C. So we will reach out to the winners via email. So look out for an email from AAII. It should be from members@ai.com or listserv@ai.com. And hopefully we can reach out by tomorrow afternoon, tomorrow evening at the very latest. But thank you so much for participating. We appreciate everyone for attending and joining in on all the fun today.
And just repeating, I guess, so there was one question that came up just now because they came in a little bit late. They're asking whether or not this recording will be available for viewing again.
That's a great question. Yes, it will be. So we usually will email all who attended today. Sorry, talking too fast. So you'll get it in your inbox, but then you will also be able to access it at aaii.com/webinars, and we hopefully will get that process by end of week, early next week, if possible. But yeah, that will be available as well as the handout and any other resources that we link or that we share with the group.
Well, thank you so much. Well, again,
Excellent.
a great presentation, Raymond. A lot of good information. Our members really enjoyed it. And this is just a taste of what you can get if you do attend the course. And I mean, the nice thing about, I find, education, and I think we're talking about how you can improve your rate of return, is that, you know, the difference between people that do well and those that don't is when they make poor decisions based on their emotions. And having an educational foundation, no matter what your technique, really allows you to make sure that you do what's in your best interest long-term, and you don't get swayed by what others want you to do. And I think that educational foundation is what is really critical to a long-term successful as far as finance goes. With that, I'll turn it over to Ray.
Yeah, I just wanted to add, I'm going to conclude. Please don't forget about active investing. That person asked about options and things of that nature. That's coming up. We really think that's going to be a big draw here, and really will be a niche for a lot of our members going forward, a more active investing approach. And I do just want to say hi to all the AAI chapters. I think I've lectured 27 of them over the years, most of them more than one time, and all the AI members and friends that I have out there. So thank you.
Well, I want to say a big thank you to John and Ray for guiding us through the EI course. And then, like I said, we'll try to reach out to the winners via email by tomorrow afternoon. And then if you have any questions about the EI course, including its content, platform, certification, pricing, anything, feel free to email us at members@aaii.com, or you can call 708-742-8774, and that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then just as another reminder, all attendees can get the exclusive holiday discount that was mentioned, as well as that BOGO deal, that buy one, get one. So please visit www.aaii.com/VES-education/holiday. And I dropped that in the chat multiple times, so hopefully everyone has that. And then just remember to contact member services if you do take advantage of that BOGO deal, either by email or phone after you purchase, to provide them with your recipient's information so that they can get access as well. And as I'll just reiterate one last time that this presentation was recorded and a replay will be available at aaii.com/webinars. And then webinar attendees will also receive that email that I mentioned with a link in the next few days. And then you'll also receive a copy of Ray's presentation slides, as well as any other links to other resources that we think are helpful. So we'll include all that in that handy dandy email. And so with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you so much and take care.
Thank you. Thank you so much. Take care.
Thanks, guys.